There's $1.65 trillion of debt sitting behind the AI build-out that does not appear on anyone's balance sheet. Not Meta's, not Oracle's, not CoreWeave's. And here's the part that should genuinely concern you. We do not actually know if that number is 1.65 trillion or if it is double that, because you cannot count what nobody is required to report. That is roughly $300 billion more than the 5 biggest companies in this space disclose up front, which means there is more than twice as much debt in AI as most people think. The money did not vanish. It was moved into structures specifically designed so that it does not have to be shown to you. And a very large amount of it is being funded by pension money and insurance money, including, quite possibly, yours. I'm Marcus Cole. This is Tech Watch AI, where we follow the money the financial media won't touch. Let's get into it. Let me explain the mechanism, because once you see it, you cannot unsee it, and it explains almost everything strange about this industry. The tool is called a Special Purpose Vehicle, an SPV. It is, functionally, a small company created for one specific job, in this case, building and owning a single data center. Here's how it works in practice. Take Meta's Hyperion data center, $27 billion. Meta will be the only customer. Meta pays the lease. Meta is, in every sense that matters commercially, the entire reason the thing exists. But Blue Owl bought 80% of that venture. Meta bought 20%. And because 20% is not a controlling stake, that $27 billion of debt sits off Meta's balance sheet entirely. Meta gets the data center. Meta gets the compute. Meta pays the lease that services the debt. And Meta's reported debt figure does not move. There was a Wall Street Journal report that Ernst & Young had flagged this structure as a red flag. And then, and I want you to sit with this, Ernst & Young signed off on it anyway, which raises a question I think is worth asking out loud. What exactly is the point of an auditor at this stage? Now here is where it stops being about one company and starts being about the entire sector. Most data center deals are structured this way. Not some, most. And once you understand the flow of money through an SPV, the risk becomes obvious. The SPV raises the debt. The money flows into the SPV. The SPV buys the GPUs, builds the facility, covers the operating costs. Then, theoretically, eventually, revenue from the customer flows back into the SPV, and the SPV pays out to the investors. The entire structure depends on one thing, the customer paying. If the revenue does not arrive, there is nothing to pay out. And in a great many of these deals, the loans are non-recourse, which means if the SPV fails, investors can sue the SPV. They can seize everything the SPV owns. They cannot touch the parent company at all. There are exceptions. Meta committed to making bondholders whole on Hyperion. CoreWeave's SPVs are technically non-recourse, but you can eventually reach CoreWeave itself. But the general architecture puts a legal wall between the company that benefits from the data center and the investors who funded it. So now ask yourself a question. What happens if you have thousands of these vehicles, each holding $500 million to several billion dollars in assets, and a meaningful fraction of them fail at roughly the same time? They liquidate, all of them. They dump their GPUs onto the market simultaneously because they legally have to. What happens to prices when a wave of supply that large hits a market at once? Nothing good. And every remaining SPV holding GPUs as collateral watches the value of that collateral collapse, which triggers their own covenants, which forces more liquidation. That is not a market correction. That is a cascade. Let me put the debt structure in terms that make the absurdity visible. The debt being used to build these data centers has a duration of, at the very low end, 5 years. At the top end, 20 years. The assets being purchased with that debt need replacing every few years. Being generous, every 5. So you're borrowing over 15 or 20 years to buy something with a useful commercial life of maybe 3 to 6. That is taking out a mortgage to buy a pair of shoes. Very expensive shoes, but shoes. And the obvious follow-up question is, what happens when the chips need replacing before the debt is paid off? The honest answer appears to be that nobody thought about it. Not that they considered it and dismissed it, that the question does not appear to have been seriously asked in the underwriting. Because if you are investing in one of these project financing loans, you are getting repaid out of client revenue over time. You are not getting a full payback in 6 years. And in 6 years, you will be multiple GPU generations behind. The hardware in that building will be obsolete, while the loan servicing it still has a decade to run. And there's a more basic version of the question that is even harder to answer. What if the client does not exist in 4 years? That is not a rhetorical flourish. The customers here are AI startups that are almost universally unprofitable, or hyperscalers reselling compute to those same unprofitable startups. The revenue that repays this debt originates ultimately from companies burning billions of dollars a year with no clear path to profitability. Now you might be thinking, this sounds like standard project finance. Companies build things with borrowed money all the time. Why is this different? Because of who is holding the risk, and because of what happens when the covenants break. Most of these loans carry covenants, contractual thresholds that must be met. A specific amount of client revenue must be flowing in by a specific date, or the borrower is in breach. In some of these agreements, if a client fails to pay for 3 months, that immediately constitutes a breach, at which point the operator has to feed their own money into the vehicle to make investors whole. And these operators, the CoreWeaves, the Applied Digitals, are themselves financially stretched, and their only source of income is AI companies that are not reliably paying them. So the failure mode is, client does not pay, operator must cover the gap, operator cannot cover the gap because their revenue depends on the same client. One of the covenants in a CoreWeave agreement required revenue to be flowing from the data center by the middle of 2027. That is not a distant deadline. And the problem is not primarily that these projects are not being built at all, it is that they are not being finished. A half-finished data center cannot deliver contracted compute. And when you cannot deliver contracted compute, the client gets to walk. Microsoft has a clause in its contract with Nebius allowing it to cancel the entire agreement if delivery milestones are not met. That is in a public filing. And I would be surprised if that clause is unique to that contract. So the delay does not just cost you time. The delay hands your customer a legal exit at precisely the moment you need their revenue to stay compliant with your loan. And meanwhile, lead times on some energy infrastructure are now pushing 144 weeks, nearly 3 years. These projects do not have 3 years. Many of them do not have one. Here's the thing that I do not think enough people are talking about, and it is the part that turns a financial story into a personal one. A very large amount of this is funded by private credit. And private credit, since the last financial crisis, has been substantially funded by pension money and insurance money. The chain works like this. After 2008, Treasury yields collapsed. Pension funds and insurers still needed yield to meet their obligations, to pay retirees, to cover policies. Safe assets did not produce enough, so money flowed into private credit funds, which offered much higher yields. The reason those yields were high is that the underlying deals were risky. And then private credit found data centers, an asset class that could be described plausibly as stable infrastructure, like a power plant, like a factory, like buying property. And when has debt secured against property ever gone wrong? So now trace the specific names. Quebec's largest pension fund is invested in data center ventures. PIMCO holds bonds in this space, backed by enormous volumes of retirement and insurance money. Apollo Global, which merged with a retirement services company, put $35 billion into a structure that raises debt to buy chips, rents them onward, and gets repaid out of an AI company's revenue. Blue Owl, which is in a great many of these deals, acquired an insurance business. CalPERS, the California Public Pension System, has exposure to Blue Owl. Teachers' pensions, police pensions, firefighters' pensions, Dutch pension funds, all of them to varying degrees are in AI data centers. Most of the people whose retirements depend on those funds have no idea. They did not choose this. They were not asked. And it is worse than simply holding the risk. These funds are relying on the ongoing yield from these deals to meet current obligations. So it is not only that the principal is exposed, it is that the income stream those institutions are budgeting around is contingent on unprofitable AI companies continuing to pay their compute bills on schedule. Now, I want to address the objection directly because it is the one that gets raised every time. Someone will say, this is nowhere near the scale of the subprime crisis. There were over 1 million bad mortgages. This is maybe a couple thousand vehicles. That is true, and it is not relevant. There's no such thing as a good financial crisis. The subprime crisis was a slow boil across an enormous number of small loans. This is a much smaller number of enormously larger loans, $500 million to several billion dollars each. It only takes a handful going wrong to do serious damage. And because the vehicles are structurally similar and the customer base is concentrated in the same 2 or 3 companies, they do not fail independently. They fail together. There's also one structural feature that makes this genuinely stranger than 2008. In the housing crisis, sophisticated investors could see the problem and take a position against it. Here, you largely cannot. There is no clean instrument to short the data center debt bubble. The exposure is sitting inside private credit, inside pension allocations, inside insurance balance sheets, places that do not reprice publicly and cannot be bet against, which means the risk cannot be priced by the market until it is realized. There's no mechanism for the market to correct this in advance. It simply accumulates until something breaks. Now let me get to the 3 beliefs holding this entire structure up. Because when you examine them individually, none of them survives contact with arithmetic. The first belief is that AI demand is effectively infinite and all compute will be consumed. Investors believe this because compute currently feels scarce, but it is not actually inaccessible. You can rent Blackwell GPUs on multiple platforms right now. The scarcity is not broad market demand. It is that two companies, OpenAI and Anthropic, are absorbing the overwhelming majority of it, with the hyperscalers taking most of the remainder and Nvidia backstopping the arrangement. That is not a market. That is a handful of buyers who are themselves funded by debt and venture capital. The second belief is that the capacity is already pre-sold, that contracted demand is locked in. This claim traces back, as far as I can determine, to essentially a single analyst letter, roughly a year old, stating that around 77% of capacity was already contracted. That figure is functionally unverifiable. The contracts are private. They are not published. You cannot check it. And here's the arithmetic that should end that argument permanently. There is roughly 190 gigawatts of capacity in the pipeline. Adjust for power usage efficiency, and you are at roughly 130 gigawatts of actual data center capacity. At approximately $12 million per megawatt, if all of that capacity were genuinely contracted and generating revenue, it would represent something on the order of $1.6 trillion in annual revenue. That is roughly twice the size of the entire global software market, not twice the AI market. Twice the software market. All of it. Every enterprise license, every SaaS subscription, every piece of software sold anywhere on Earth, and then double it. That demand does not exist. It is not close to existing. What actually happened is that a few contracts were genuinely pre-signed, and that fact was extrapolated across an entire industry. And even a signed contract is only worth the solvency of the counterparty. A business can absolutely commit to paying. If that business ceases to exist, the commitment is decorative. The third belief is that these are safe infrastructure investments. This is the most dangerous one because it is the belief that unlocked the pension money. Money right now is expensive to raise, so capital is flowing toward whatever the market perceives as safe. And the market looks at a data center and sees a building. You construct the building, you switch it on, money comes out of the building. Like a power plant, like a toll road. But a power plant sells electricity to a functionally guaranteed market. A toll road sells access to a road people need. A data center full of rapidly depreciating GPUs sells compute, and outside of OpenAI, Anthropic, and the hyperscalers, it is remarkably difficult to find more than a couple of $1 billion of genuine third-party demand for that compute. There is a fourth misconception worth naming, because it drives a lot of the political enthusiasm. A great many people appear to believe that AI somehow emerges from the specific data center near them, that a facility in your region means the technology is being delivered to your region. It does not work that way. Content delivery infrastructure handles distribution, while where the compute physically sits is largely irrelevant to you as a user. So the argument that a community should accept the strain on its grid and water supply because the facility brings the future to their doorstep is, in most cases, simply not true. And here's the test that I think settles it. If demand for AI compute were genuinely as enormous and as broad-based as claimed, every company in this space would be reporting remaining performance obligations in the hundreds of billions of dollars. Contracted future revenue, signed commitments. That is what a genuine demand boom looks like on a balance sheet. Instead, the enormous RPO figures sit almost exclusively with the hyperscalers, and their contracts are largely with OpenAI and Anthropic. Look at CoreWeave. A very large share of its revenue comes from Microsoft and Nvidia, not from a broad market of enterprises desperate for compute. From two companies with a vested interest in CoreWeave's survival. This was supposed to be insatiable demand. The revenue figures do not describe insatiable demand. They describe a small number of very large customers, several of whom are also investors, several of whom are also suppliers. So let me tell you what I think happens next. Specific, with timelines. First, a chunk of capacity comes online over the next 6 months in fits and starts, and a meaningful portion of it gets absorbed because OpenAI and Anthropic are functionally the renters of last resort. That absorption will be reported as validation. It is not. It is two companies with no profitability soaking up supply because they have nowhere else to go. Second, within 12 months, you start seeing isolated incidents. A data center project encountering financial difficulty because a client did not pay. One, then two. These will be reported as idiosyncratic. They will not be. Third, 2027 is when I expect this to become systemic. That is when the covenant deadlines cluster, when the revenue milestones come due, and when the first wave of construction was supposed to be generating cash. I think we see the signals this year and the actual breakage the year after. Fourth, and this is the one I want you to hold on to. It will be slow, and then all at once. That is how covenant-driven failures work. Nothing appears wrong until a threshold is crossed, and then everything is wrong simultaneously, and then the litigation runs for years. The people who built the data centers will mostly be fine. The people holding the bag will be the creditors, which means ultimately the pension funds and the insurers. I want to leave you with one thought. The most damning thing about this whole story is not any individual number. It is the opacity. You cannot find the loan documentation. The contracts are buried. The SPVs are private. The covenants are not published. The revenue attribution is not broken out. Even the total debt figure has a margin of error measured in trillions because the structures were built specifically so that it would not have to be disclosed. That is not an accident of financial complexity. Structures like this exist precisely so that the numbers do not have to be examined too closely. And the honest position here is that this thesis should be falsifiable. If someone can produce evidence of genuine broad-based third-party demand at the scale required, contracted, verifiable, not from OpenAI or Anthropic or a hyperscaler, then the argument collapses, and I am wrong. The best anyone has offered so far is a projection. A document forecasting that demand will materialize at some point in the future. That is not evidence. That is people dreaming, so they do not have to look at what is actually in front of them. If you want to follow what happens next, subscribe. I publish regularly. No hype. No predictions dressed up as certainties. Just what is actually happening and what it actually means. I will see you in the next one.